for your time and happy Friday to you. Just looking at the relief rally, I think I should call it that, so that we are seeing ensuing across all markets as a result of perhaps seemingly cooling concerns around inflation. What is your take on this debate, and which side of the coin do you sit on?
Afternoon, Fifi, and happy Friday to you as well. The inflation debate, I guess, that's capturing the market at the moment is between those who believe that inflation is transitory, and the Fed sits firmly in that camp, and some inflation hawks who believe that inflation may be a bit more structural towards the upside. So those who see it as transitory would point to factors such as remaining slack in the US labor market, and once, for example, stimulus checks expire in and around September, you'll see more people coming back into the labor market to relieve some of that stress. Those who are a bit more hawkish on inflation would point to some cost push pressures, such as chip shortages, as well as limited capacity in the manufacturing supply chain globally, which is going to lead to further price increases. So it's probably more people are probably leaning towards the transitory nature of inflation. The Fed itself has stated as its policy that it wants inflation to be above 2% for some time, so that inflation expectations can be more anchored at the 2% level, as opposed to earlier or lower levels of inflation that we've seen in the past decade due to ZIRP. So the fact that we've reached that barrier, and at least temporarily for April, coming in at over 3%, inflation CPI in the US is not really a concern unless we see persistent levels of inflation above 3%. Only then would the monetary authorities start to act. So at the moment, the market is taking the view that inflation will peak some point during the middle of this year and then start to taper off, in which case there isn't the rising threat of interest rates increasing, and hence higher discount rates and lower asset prices.
Yeah, I mean, I've listened to both arguments on the inflation debate, and both are very convincing in my humble view, and I'm going to stick on the fence. But I don't manage people's money, you do. And I'm just wondering how the talk about inflation and your particular view on how long it stays for is influencing some of the stocks that you are putting in your portfolio right now, or perhaps some that you are reducing exposure to at this stage.
Mm. Well, there is a dilemma in terms of asset allocation for many managers at the moment. Considering the very low levels of interest rates and everything gets priced off the yield curve, we do feel, and I suppose this is pretty much a consensus view, that most asset prices are trading at historically high levels, whether you're looking at bonds or at equities, especially longer duration equities, such as growth stocks. So it does become a bit of a quandary in terms of where do you allocate tactically from this point going forward. Hence, we see the switch towards shorter duration equities like your value stocks and some of your industrial counters, as well as commodities which tend to do well in inflationary environments. At least that's for those who believe that this will be transitory and perhaps a bit longer than being transitory. So it does become a bit of an asset allocation call. And obviously, stock pickers, even if you are going to play in the sectors which have done significantly well since the COVID lockdown started, you are going to have to look to those companies that can consistently deliver on their sales and earnings growth and cash flow conversion. So it's a bit of a mixed bag between, well, if I'm still going to play the theme which has worked until now, then I need to be a bit more careful in terms of the counters I go into, versus, well, there's certain sectors and asset classes which may have been underlooked. We've already seen the run in commodities, so that's not new. But people are perhaps starting to look at areas like real estate and some of the industrial counters as well.
Yeah, and a counter that has benefited from the run in commodities that we have seen uh, to the start of last year, 2020, the first half of 2020 up until now, is Sasol. and the company coming out with an announcement regarding its latest move to right-size its balance sheet and get its house in order. What do you make of the deal, and how good could it be potentially for people who are wanting to dabble in Sasol stocks?
Well, as you stated, Sasol has been on an asset disposal program for pretty much over a year now, and that is a function of them needing to pay down debts and restructure the balance sheet to put the company on a firm footing going forward. And this latest announcement is no different from that. They held a 50% stake in the Mozambican pipeline company, and one of the, I suppose, strategic benefits of that holding was a steady supply of gas towards Secunda. That will continue even after the sale. So they reduced their stake to 20%, selling 30% to a consortium. And so, to some extent, this is de-risking their exposure to the company while still maintaining the logistics and transport benefits of gas to their assets in South Africa. They'll receive about 4 billion rands from the transaction, with the possible additional billion rands dependent on future performance. So they do get a nice cash inflow from that. Another potential reason may be de-risking exposure to Mozambique at the moment, which has a bit of country risk given the political instability in certain regions, and we have seen a few divestment announcements over the past 2 months or so in that regard.
Yeah, I also couldn't help but notice the chronology of events there following those attacks in Mozambique that you did refer to, and Sasol now announcing its plan to reduce its exposure from the country, not entirely exit. But Thato, thanks so much for your time and for your insights. That was Thato Mashigo, Portfolio Manager at Sanlam Private Wealth.